and Tom Heemstra, and I'm here today with Kelly Buckley. He's the managing principal at Spectrum Financial Alliance. Spectrum Financial Alliance is a unique concentrated asset management firm that specializes in providing personalized services in asset management, insurance, estate planning, and financial planning. So Spectrum has been in business for 25 years. In addition, Kelly's a 1979 graduate from the United States Air Force Academy. And he's ingrained the core values of the Academy: integrity first, service before self, excellence in all we do, into his business and everyday life. He's also a retired B-52 and F-16 fighter pilot and a good friend. So I'm going to ask Kelly some questions today to help the Delta pilots who are facing early retirement questions and asset management questions, and we'll just go with that.
Sounds good.
Okay.
I'm ready.
All right. Well, Kelly, I know that flying, of course, was a passion, and now asset management and financial planning, all that financial world is also a passion of yours, and it connects with your purpose for the firm and performance. So can you give an idea for our viewers what that has all done?
Yeah, Tom, it's just like flying in a way, because in professional asset management, what you're doing is you are learning to work with limited information and make rapid, accurate decisions. And, just like we did in the F-16, sometimes those decisions are not perfect, but you find a way to get the mission accomplished. And in terms of our flying backgrounds, you find a way to get there on time. So I found that being prepared to fly, meaning having the proper training, the proper educational background, etc., that's what defines a good pilot, as well as their judgment, their character. And it's the same thing in our business. For that reason, in our firm, when someone is responsible for managing life savings of our clients, they have to have an advanced education. They have to have high-level certification. And they have to have decades of experience. And that experience has to be proven experience. And we believe that's led to the success of our clients' investments.
You're bringing up education, expertise, and I coined it the EQ, because education, expertise, and experience are like three multipliers that make you special here in the role that you do here.
Yeah. And I think that's true. And, before I came into the business, while I was on active duty, I completed my MBA in finance. But I also completed 3 years of working as an adjunct professor at 3 different universities and teaching finance to undergraduates, investment to undergraduates, and macroeconomics. That, and really a lifetime of interest in investments and business, I think is what's made me effective. I've also completed 33 years ago the Certified Financial Planners curriculum, as well as all the continuing education we do every 2-year cycle. So, in my opinion, if you haven't seen 4 or 5 market cycles, if you don't have the appropriate level of education, and then temperament, investment temperament, it's very difficult to be successful. And of those 3, believe it or not, temperament may be the most important. Temperament means understanding you can't go with the flow necessarily in the investment world. You have to seek value, and your timing has to be impeccable on purchase and sale of assets. And you have to have pretty good judgment on what sectors and industries are likely to outperform. That's what we try to do every day.
And those things are all important in the cockpit, so I'm sure the viewers can relate to and see how that's a major performance special. And so there's some unique things that distinguish Spectrum Financial Alliance from other firms out there. So would you mind hitting a few of those?
Yeah, I'd be glad to. I kind of came through a progression in the industry, because my first 8 years were with a major wirehouse firm. And as an advertisement for them, I'll say Merrill Lynch. And, as a broker, as a stockbroker, and I learned a lot there. But when I made a decision to leave Merrill Lynch, I did it by going to the nation's largest independent broker-dealer to escape proprietary conflicts and entanglements. And that's when we progressed to LPL Financial Services. So I independently owned our business at that time, and I got to see the ability to run the business, utilize products that didn't have management push and quotas behind them. And after about 8 years of that, we progressed to being a full registered investment advisor. We're considered a money management firm. We're not tied to the brokerage industry. We're not tied to the insurance industry. So by doing these things, what we did steadily is we eliminated conflicts that muted our clients' performance and that raised their costs. So that is one of the things I think that makes us special, because as a registered investment advisor, we are considered a fiduciary, which means that 100% of our decisions have to be in the best interest of our clients, not our firm. And that keeps things straight. That makes sure that our clients have minimized cost and the best opportunity to perform in line or outperform the markets.
Right. And there's many firms that use that term a little more loosely, fiduciary, and so there's confusion out there for some of us clients that we don't really understand it. But for you, it lines up with your core values of integrity.
I think a lot of firms, Tom, discuss their corporate values, but we see a lot of accounts come in the door every year. We brought in a little over $20 million year to date. These are accounts that refer to us from clients and other sources. And what we see does not line up with best practices. And in many cases, what we see has hurt the clients more than it ever helped them. So our job is to put the client first. So if you talk to anybody in our firm, you say, what are the 2 rules at Spectrum? Rule 1 is the client comes first, and we mean that. Rule 2 is asset gathering. And if there was a rule 3, it would be rule 2 never trumps rule 1. So we feel that if we put the client the focus of everything, if we work hard in their financial planning, which is a complimentary service we offer through our certified financial planners, with our asset services, that good results are going to continue. And because we believe in our results, we advertise them. We've also found, particularly in Delta's market, where there are several other service providers, that our competition doesn't advertise their performance. Our performance that's advertised is all accounts, net of all costs. That's growth accounts down to minimum volatility accounts. Nothing's left out, nothing's cherry-picked. And again, that gets back to my internal value, which is that performance does matter. And if we want to make a difference in our clients' lives as asset managers, what we need to do is ensure that they've got the best return they can possibly get at minimum cost.
So we can talk about the values there, and is there anything else on that you want to add?
I believe that investment performance, when I walk in these doors, is the only reason I'm here. In other words, to me, performance matters. It's not about muting performance or using excuses for why your performance does not equate to the markets. We do annual reviews with our clients every year, where we give them a direct report on their net returns versus the industry norm versus the S&P 500 and other relevant indices. And we do that because we're proud of our numbers. So, I think we can improve. I think we can be better in the future than we've been in the past, because frankly, I've got a better crew to work with than I've ever had in these past few years. And that's a difference maker for me, because it gives me more time to focus strictly on our portfolio management and let the good folks I've got around me take care of running the business and doing the other things that have to be done day to day.
Yeah, as pilots, we can relate to having a great crew, so
yes,
so that's amazing. And then, I was going to say that, I've been through 3 or 4 advisors before too. I'm proud of your numbers too. So I've been with Spectrum for 17 years and wouldn't go back, and highly recommend that we connect with these Delta pilots at this time in their life when they're assessing their retirement funds, if they're ready, or if it's how soon it's going to come, and how do they go from there. Many of these guys have probably seen some of those very common errors or disappointments with their previous providers, but they're looking for something special, and Spectrum certainly is that.
I think a lot of what we see in the industry is driven by the fact that the industry trains folks in sales. They're not trained in managing money. The industry's educational attainment does not lend itself towards somebody that understands numbers or analysis. And we try to incorporate all of that. One of the tools we've invested in the last 11 and a half years is Morningstar Inc. And Morningstar assesses our clients' returns so that what we're presenting is fairly presented and is an exact depiction of what we've actually accomplished. We've also purchased data from Dalbar Inc., which is another very large econometric firm. And what Dalbar shows is what we see consistently from accounts coming into our firm from other service providers, and that is a level of mediocrity that equates to roughly half of our long-term returns. And so we don't seek to over-diversify accounts and then use that diversification as an excuse for poor performance. We believe that performance matters. We believe that financial planning truly makes a difference in the lives of our clients, and our recommendations are made on that basis.
And I can't remember if it was Jimmy Buffett or Warren Buffett had some quote about over-diversification.
I think that was Warren. Warren Buffett is the long-term chairman and CEO of Berkshire Hathaway, and Warren just turned 90 a few days ago, so happy birthday, Warren. Warren's someone who's built a great company off of concentrated investment style. And, we advertise that we are a concentrated and predictive style. That means that it's relatively common that we might have 10% of a client's assets invested in one company, because we're going to buy what we believe and know has the best current valuation and the most upside for our clients with adequate safety margins. Warren's work is exceptional, and he's been called the greatest investment manager of all time, but our firm has beaten Warren's returns at 9 out of the last 10 years. Again, that's all accounts, net of cost, and that's a record we intend to continue unless Warren retires after me, which the way he's going, he might.
Well, and he said, over-diversification is not an excuse for ignorance, right?
Yes, he did. That's right. And I agree with that. I think over-diversification could be an excuse for ignorance. But in my industry, I think it's really an excuse for why stuff is thrown on the wall to see what will stick. In other words, you buy a little bit of everything, ignoring all the macroeconomic variables, fiscal and Federal Reserve variables that really direct cash flows in our economy and cause some things to go up and other things to go down. So we look at all that data. We seek a portfolio that's optimized, that is diversified, but we're not going to over-diversify for the excuse of saying we've got great diversification.
Well, and your performance is very transparent to your clients.
Yes.
You're very open and accountable, accessible if you have questions. But, when you're hitting those highs, it's obvious you are exploiting some highs there that you saw, not through ignorance, but through analysis and deep study what was coming. And then, so the highs are there and amazing, and then the lows, your prediction of lows, I think, is unbelievable. Would you mention what's going on there? Yeah,
I will. So, there are certain signs in the market when you reach interim lows, and I call them capitulation selling signs. The last one we saw was on March 23rd of this year. We identified that low in a letter to clients on April 2nd, so it was a little over a week later. And it turns out that was the low, as I had predicted, for a market cycle. Right. Now, the market's up about 60% from the low, and we believe that performance is going to continue. Prior to that, on December 24th of 2018, following a terrible quarter for the market was down 20% for the quarter, and in the month of December, as of the 24th, Christmas Eve, it was down 10%. We wrote a letter to clients dated December 24th, stated that we believe that was the low for a market cycle, and incorporated our cash and our assets, managed assets appropriately. That was the low for a market cycle. and kicked off an incredible year for us in 2019 because we maintained our position instead of selling into weakness. Previous low was in February 2016. We called that one to the day of the low in a letter to clients, and I could go on. But what I try to do is analyze markets. I do that every minute of every day. That gives us maybe a little better track record than most on identifying where investment opportunities are greatest and then employing our clients' cash. But you have to understand we are a predictive style. And so we're looking forward because there are no rear view mirrors in jets, are there? You don't have mirrors.
Let's see. The rear view mirror, yeah. So yeah, and you're talking active management, right?
Yes.
Because passive management is, buy and hold, put it on autopilot, right?
Yes.
And just let it ride and hope you hit something good, right?
That's true. And Tom, if you think about it, if you put it on autopilot, just leave it there, eventually the engines are going to flame out. I like that analogy. Yeah. I'll come back to that one.
Okay. All right. Is there any other differences?
We're just hardcore money managers. We believe in active money management. You brought that up. I find that the majority of our colleagues in the business, including those who offer services to Delta, are passive styles. And Tom, in my experience, and in anything I've ever done in life, passivity has not helped me. So we're an active style. We believe that gives our clients the best chance to perform adequately or outperform the markets. And we're going to continue to do that because it works.
As you know, some of us airline pilots are active and not passive. We don't mind taking a little risk, and so some of us have done foolish things with our money or had investment advisors that didn't take care of our money very well. So we made mistakes with our money, right? And so some guys are probably thinking, "Hey, Kelly, is it too late? I'm close to retirement, and what do I do to make sure it's not too late? How can you help me? Because I'm kind of hurting right now."
Okay, that's a really good question, and I think most folks know that this year, since the market did hit its bottom on March 23rd, it's had a large upside move. But that upside move has not totally captured, based on the industries we have overweighted, even the decline that occurred over the 6-week period from March 23rd. So here's our bottom line. We believe that our portfolios have an additional upside move of 20 to 30% likely between now and December 31st. And more importantly, back in 2016 in September, we called through social media and letters to our clients our view of how the election would work to our clients' benefit. And in that call, we said that overwhelmingly President Trump would be President Trump. We know he got 302 votes there last time. We called the election this cycle in July in a Facebook Live presentation that we did, and we believe the result will be much greater than that. The reason this is important to our clients gets to your question, is it too late? It's definitely not too late because President Trump's policies are extremely likely to be reelected on November 3rd. Those policies, we already have a model for. It's 1982 and it's Ronald Reagan. So the likely run that the equity markets will have will be extremely long and sustained. So the 20 to 30%, that's just looking at December. But we believe the next 4 or 5 years are going to be well above average in terms of return to equity investors. We also believe that those who are holding bonds or bond funds are going to get beat up really bad because at some point here, we're going to see interest rates start to go up dramatically. That's going to be driven simply by market forces, but also by the Federal Reserve's decision a week ago to utilize techniques from their perspective that increase inflation. As inflation goes up, interest rates go up. They move in lockstep long term. So bonds are going to be beat up bad, and that's going to go on for years, in our opinion. And we're going to see selected equities, the sectors, the industries that we've overweighted, realize a lot of benefit between now and the end of the year. and then the market realized a lot of benefit in the next 4 to 5 years.
Well, a couple more things and we'll wrap it up here. So
Yeah.
I thought maybe we could do a lightning round where I just say a word or two and then you respond with the first thing off the top of your mind that relates to finances.
Now, this isn't like that Scrabble game you made me play, is it?
No. So the lightning round. All right, this has been reported out there and published. Dow 100,000.
18.5 years.
Really? Okay. Dodd-Frank.
The biggest excuse for blame shifting from Congress ever seen in the United States history.
Okay. All right. How about situation awareness? SA.
SA is as important in our industry as it was in flying jets.
Okay.
It really is.
Yeah, I agree. All right. How about the danger zone?
The danger zone is managed products, mutual funds, passively managed ETFs, day trading, and tips from your brother-in-law.
Yeah, don't loan him money, right? All right. How about anything else about SFA, Spectrum Financial Alliance extra services that you would want to mention?
We take pride in all of our services. We believe in investment excellence, but we also believe in excellence in all we do. So any services we provide are going to be of the highest caliber, or we're not going to provide them.
Okay. And then on time, on target, right?
On time, on target, every time.
So as we bring it to a close, can you tell them how easy it is to come on board?
Yes, I can. So we have a two-step process. The first is completing an investment and financial profile. Everyone is unique and different, Tom. Everybody has different goals. Some of them are close, but they're all unique. So we go through a profiling process to learn more about the unique variables that apply to that person and or that family. That tells us who they are, and then we develop a written plan. It's the second step that we present to them in a bound volume that identifies the financial planning that we're recommending they undertake or implement, I should say, to solve any financial problems in their life, and also identifies their specific risk tolerance so that we can assign a portfolio, whether it's growth or growth in income or minimum volatility, that fits their needs.
All right, and then it's welcome aboard, right?
That's it.
Thanks, Kelly, for your time.
Thank you, Tom.
Awesome.
Appreciate it.
There's people out in the economy that see the overspending of government, the national debt, the kind of the over-exuberant stock market that they don't quite understand when the economy's been shut down like it has.
Yeah.
Right. So, the national scene, there might be some things that you might want to talk about.
I think those are all, those are pretty much interrelated. But months ago, we said it was likely that our nation would see a vaccine by the end of the year. Yesterday, the CDC announced that they expect to have a vaccine beginning to be distributed in October. Now, the vaccine's kind of the key to economic shutdown because our country chose to devastate our economy, destroy folks' dreams, and shut down their businesses by shutting down in a pandemic. This country's endured many pandemics, and we've never shut down our economy. This time we did. So the reopening is the key variable to continuing this economic growth and to the market continuing to move up. We've said and still believe that that reopening will progress at a much faster than expected rate, and the market, the equity markets, are a forward-looking vehicle. So when you see them going up and what we forecast and we see them achieved as a V-shaped decline and then a recovery, when you see that, that's the market saying, hey, I'm not looking at what's out there right now with all the problems in the streets and the problems with people having their doors closed for their businesses. I'm looking ahead about 6 months. That's what the market does. So it's looking out past the end of the year, and it's anticipating the forces that will cause the economy to enter a new growth phase. And that's exactly what we believe it's going to do.